Position sizing and capital allocation are essential elements of risk management in trading and investing. Properly determining how much capital to allocate to each trade can greatly influence profitability and limit potential losses. Without a structured approach, traders risk overexposure and increased drawdowns, which can lead to significant setbacks. In this lecture, we will explore professional frameworks that help optimize position sizing to balance risk and reward effectively. Position sizing is a crucial aspect of risk management that determines how much of an asset a trader should buy or sell in a trade. Proper position sizing helps control risk per trade, prevents overexposure to a single asset, and ensures consistent portfolio growth. It also protects traders from making emotional decisions that could negatively impact their performance. One widely used method is fixed fractional position sizing, where a trader risks a fixed percentage of their capital per trade. This slide presents two key position sizing methods to manage risk effectively. The first example follows a fixed percentage risk model, where a trader risks 2% of a $100,000 account per trade, leading to a position size of 400 shares based on a $5 risk per share. This approach ensures that risk remains proportional to account size and does not significantly impact the portfolio. The second method, fixed dollar position sizing, allocates a set amount, such as $5,000 per trade, regardless of portfolio size, resulting in 50 shares at $100 each. Both strategies help traders control risk, but the best choice depends on individual risk tolerance and trading style. Volatility-based position sizing is an advanced technique that adjusts trade sizes based on market conditions, helping traders manage risk in highly volatile environments. This method uses the average true range to determine stop-loss levels and adjust position sizes accordingly. In the given example, with a $100,000 account and a 2% risk per trade at $2,000, the ATR is $2, and a multiplier of 2 is applied, setting the stop-loss at $4 per share. Using the formula, the trader determines a position size of 500 shares. This approach helps traders maintain consistent risk exposure, especially during volatile market conditions. When constructing a portfolio, capital allocation plays a key role in managing risk and optimizing returns. Equal weighting is a simple approach where each asset receives the same amount of capital, as seen in the example where a $100,000 portfolio is split evenly among 5 assets, allocating $20,000 per asset. On the other hand, risk parity adjusts allocations based on each asset's risk contribution instead of equal capital weight. For instance, if stocks have 20% volatility and bonds have 5% volatility, more capital should be allocated to bonds to balance overall portfolio risk. The Kelly criterion is a mathematical formula used to determine the optimal capital allocation per trade, maximizing long-term growth while managing risk. It considers the reward-to-risk ratio and the probability of success to calculate the ideal fraction of capital to allocate. In this example, with a 60% win rate and a 2-to-1 reward-to-risk ratio, the formula suggests allocating 40% of capital per trade. However, since the Kelly criterion can be aggressive, many traders use a more conservative approach, such as the half-Kelly strategy, reducing the allocation to 20% to limit risk. This method helps traders optimize returns while maintaining a controlled level of exposure. Value at risk, VAR. Allocation is a risk management technique that estimates potential portfolio losses in adverse market conditions. It uses historical data to determine how much a portfolio could lose with a given probability, such as a 95% confidence level. In this example, the portfolio's VAR is $5,000, meaning there is a 5% chance of losing more than this amount in a given period. If this level of risk is unacceptable, traders can reduce position sizes to better align with their risk tolerance. This method helps investors make informed decisions by quantifying potential downside risks. Selecting the right position sizing strategy is essential for different types of traders and investors. New traders often benefit from fixed fractional position sizing, while active traders may prefer volatility-based sizing to adapt to market conditions. Long-term investors use equal weighting or risk parity, whereas high-risk traders may apply the Kelly criterion, with adjustments to manage risk exposure. However, traders must avoid common mistakes such as over-leveraging, ignoring correlation, inconsistency in strategy, and emotional decision-making. In conclusion, mastering position sizing and capital allocation is essential for long-term success in trading and investing. Structured approaches such as fixed fractional sizing, risk parity, and volatility-based sizing help ensure proper risk control and portfolio stability. By choosing a strategy that aligns with risk tolerance, trading style, and market conditions, traders can optimize returns while minimizing potential losses. The key to sustainable success is maintaining discipline and consistency in applying these risk management techniques. A well-planned approach to capital allocation can significantly improve trading outcomes over time.